What's up and welcome back to my channel. So moving on from last video, I did mention that I lost over $250,000 in the market, and I thought once again, if I can share my successes, then why wouldn't I share my failures so that you guys can learn from it? So I'll tell you exactly how that happened, and I'll touch on all the sort of errors that I made. A lot of these errors are what I call schoolboy errors, and I think the nuts and bolt of it was I got too complacent, because these are errors that I never would have usually made. But anyways, hope you enjoy the video, and if you have any more questions, just ping it across in the comment section, or contact at JVceo, and I'd respond to those as well. If you're new to the channel, make sure you like, comment, and subscribe, and I look forward to having you enjoy my future videos. So first thing being, the market has been really choppy. The truth of the matter is, prior to the market getting choppy around sort of February ending / March, the market was relatively easier to trade, and it was easier to make huge amount of gains. You had a lot of 1,000% days and 2-3,000% sort of stocks. That all came to a grinding halt around, I would say, around March. So I think that is obviously the core reason why I sort of lost the funds that I did lose. Moving on from that, I'll talk about stop losses, which I mentioned in my last video as well. So I sort of got into a habit of using mental stop losses, but then I wasn't being very strong with my mental stop losses. So I would say to myself, all right, cool, my mental stop loss, let's say I'm buying at 10, I might say to myself that my mental stop loss is $9. That way I'm only losing 10% on it, for example. But then when it gets to $9, I'm thinking, oh, I've got 50 grand in this. I'm really not trying to lose 5,000. So you know what, let me wait for it to recover. And before you know it, I'm down another 5 grand, down another 5 grand. And I think the learning from that is, is don't depend on the mental side of things to sort of keep you safe in the market. Use the physical stop losses because they're there for a reason. Because rather than sort of taking that 5 grand loss, resetting and getting into a play that may have given me a 20% or 30% return, I then ended up taking, let's say, a 50% loss on that. So now losing maybe 25 grand out of my initial 50 grand investment. And whilst we're talking about that, I'm going to talk about something else, being greed, right? But greed in a couple of different ways. The first way being refusing to actually take smaller gains. I think that was another big reason why I took a lot of losses on the market. Well, not a lot of losses, but I took a big loss during that period. So I'll give you an example of what I mean by greed, right? So there's a stock called CLWD, that's Cloud Commerce, and it's a AI company, artificial intelligence, and I think like marketing and all of that sort of stuff, right? And this stock, I anticipated it doing at least a sort of 5 to 7x for me, so around 500 to 700%. But I got so blinded by pursuing that I failed to realize when it was trading in a consolidation range. Well, that's not true, because I realized it, but I didn't actually use it to my advantage. So the stock was trading within a range. So, let's say I bought it right here. It would trade from here to here. I would usually be around 100%, but I wouldn't cash in because I'm waiting for, 5x's, 7x's. I wouldn't cash in. I think I had around maybe 30, 40 grand in it. So I'd be like 30, 40 grand up, and I just wouldn't cash it. It would go back down to my entry point, or slightly beneath my entry point. Maybe I'm now minus 10%. And then it'll go back up to that area again. I'm up again 30, 40 grand. I wouldn't cash it. It done that around 3-4 times, and I never cashed it. And if you actually look at that, that was around a 300 to 400% gain, albeit taking profit. You're not getting that gain all at once. You're actually taking profits along the way. But that was one of my very, very, very big flaws in the market. I always had a habit of taking profit, but I think when the market was really hot and I was seeing these 1,000% gains, my mindset sort of changed, and I started chasing those. And I just didn't value 100% no more. I didn't value, mate, what's 20%? What's 30%? I didn't value those. and I think I ended up paying for that as well. So that's part of the reason why I lost the money that I lost. Moving on from that, I would definitely advise take profits along the way. So even if it's not, in a manner that I've explained, take profits along the way. So now again, my strategy has changed because I took learnings from that. So now, for example, let's say when I bank 30 to 40% on a trade, I would usually take 2/5 of my position out. So, for example, if I put in 100 grand into that position, I would usually take around 40 grand off the table, because at least that way I've banked something. I'm safe, and then sort of let the rest ride. And then if it goes up again, I'll take another 2/5. And before you know it, you got back your original investment, and now that's a risk-free trade. So that's definitely one of the things that I've learned from that. Again, I'm trying to be a lot stricter with myself because I think it's all well and good putting all these rules in place, but sometimes you go in the market and you lose your head. That's what happens to a lot of people, regardless of how experienced you are. I'm quite experienced, but again, clearly, I'm not above making mistakes, and not even just no, not even intricate or difficult mistakes or big mistakes. It's more like the little sort of schoolboy errors that I made, and I pay dearly for it. Again, within that same notion, I think I talked about this in my previous video. I just wasn't trading my plan. So I would say to myself, oh, if I make 150 grand this month, I'm going to bank, and I just wasn't doing that, and I would end up doing 150 grand, let's say in 2 weeks, and then going well past that mark of victory, and again still not banking. So it's funny enough, that's I think one of the laws, and of course eight laws of power, but it's something along the lines of do not go past your victory mark. And I was doing that several times, but that's the greed kicking in. So that's definitely something I'll ask you guys to incorporate. Another thing being, I think there's this whole notion on the stock market about averaging down, and let's break down averaging down, right? So averaging down is essentially speaking, it's not really dollar cost averaging because it's not used in that context, even though that's what it boils down to. But dollar dollar cost averaging for me is more conscious. Averaging down is more, generally speaking, you doing things out of being in a loss, essentially speaking, to be put quite simply. Whereas I think dollar cost averaging is, you could dollar cost average up, you could dollar cost average down. It's strategic. You're saying, right, cool. If it goes up 5%, I'll add another X amount in there. Whereas when you're averaging down, mostly. I think when we use the word averaging down, it's because you're in a loss now. Now you're trying to bring down your overall average on that particular trade. Essentially speaking, that's what it is. Hence why it's called averaging down. And I think there's this notion in the stock market of, oh yeah, oh it's down 20%, just average down. But I think you kind of need to be careful, and you need to cut your losses quicker, because it's very easy to say you're averaging down, and really all you're doing is throwing money in a pit, money you would never get back. So I have penny stocks that I've got 100 grand in, 120, 130 grand in, and I averaged down on those, and unfortunately now these companies are now SEC delinquent and so on and so forth, and essentially speaking, the funds is gone, it's disappeared, poof, into thin air, and that's all because of averaging down. Whereas, if I never done that, I probably would have still lost money, but nothing near the current amount that I've actually got invested in those particular projects. And I think it's really about setting a max and sticking to it. And what I mean by setting a max and sticking to it is, if I go into a trade with say 10,000, right, and I say to myself, right, the max I'm going to put into this trade is 20 grand, regardless of how low that particular stock goes. Once I've put in the 20 grand, I shouldn't really go past that. But averaging down is a way of tricking your mind into continuing investing in that stock in the hope that it brings down your overall average so that you go into green quicker. which in the ideal world is a brilliant sort of approach and a brilliant idea. But most times you're sinking money into a money pit that you would never get back, and then you end up overspending on a particular stock, and you pay dearly for it. So I'll definitely say keep an eye on that area, because that's one area where I ended up stocks, the stock pairs that I initially had 20 grand in, I ended up having 100 grand in them. How the hell did I get to 100 grand when my initial sort of budget on that particular stock was putting in only 20 or 30 grand, because I was averaging down? Also, as I mentioned at the start of my last video, I think being abroad didn't help. When I was in Ghana, I lost a lot of money, simply because of just bad internet. The market was crashing around that period. I wasn't able to, make fast decisions of pulling out funds and, staying liquid in that regards and whatnot. And by the time I was able to get internet access, I was already down heavy on some of these positions. And then I became emotionally attached to those positions and then just didn't cut the losses. And then some of the losses got bigger and bigger and bigger. So I think that was definitely another reason. I think, of course, you're not all going to be in Ghana. So there's no learning to take from that point in that regards. However, the learning you take from this is cut your losses quick. Cut your losses quick. Do not wait. Like, have max, to be fair, I'd say 10%. Once you're beyond 10% minus 10%, cut it. Because otherwise, I mean, there are people in like stocks like ATVK, CBBT, and they're down 97%. They're down 80%. That's just crazy. That's mind blowing. So just cut your losses quicker and you'd excel a lot more in the stock market. Also, something else that I did was I'd done a lot of research before a lot of my investments, but then I was not. Sometimes I just done the investment, and then I left it, and then sort of cracked on with life. But I think when you're invested in these companies, especially when you're investing the amount that I invest in these companies, you should continually, keep doing research and keep learning more about these companies and whatnot. The reason why I say that is, things happen, directions change, fundamentals change. Fundamentals change. It might not be in the short term. It might be in a mid term, or maybe in a long term. But definitely fundamentals change. But when you're in a position where it's like, oh right, I done a whole bunch of research at the start, so I don't need to look into this no more. I'm happy with it moving forward. What happens if 3 months down the line, the CEO is now underperforming, or the CEO is no longer following through with the roadmap that he set for that company initially? Now you're in a position where, essentially speaking, the money you've actually put into that company is no longer valid, because you put in that money based on a false notion which is no more relevant to that particular company. So that's why you got to stay on top of your research. And that's, again, something that I wasn't doing too well, because I was always chasing after the next 1000% or the next 2000%. So I wasn't keeping up to date with, trying to stay current with the actual tickers that I was in that particular moment. One big reason why I lost a lot of money, relative again, because obviously overall, obviously it's a small portion of my portfolio, but still, is I got overly dependent on penny stocks. It's really that simple. I got overly dependent on penny stocks. So I got to a stage where literally 90% of my whole portfolio was penny stocks. And if you ask me, that's terrible. Like, there's no reason why you should, have such hundreds of thousands, in penny stocks. Like, that's absolute madness. And that's definitely an area where I went wrong in. I should have had it in safer stocks. The reason why I say that is, let me give you this breakdown, right? So you got a penny stock, and then you got Tesla. Tesla, I mean, people can say all what they want about Tesla, but Tesla isn't losing 70% a day. It's not happening, right? So even the crash, for example, I think Tesla lost around 30% or whatever the case was, and that's quite massive, but that's just 30%, right? Whereas now a penny stock, because they have run so rapidly, and you might not have bought it at the lowest of the lowest, it might keep losing, 70% every day. And by the time it actually then settles down at a floor, you realize that you're 2000% or 1000% or 500% away from the top. And that's the danger or dangers of penny stocks. They're very rapid when they run, but they're very rapid when when they lose as well. You know, yeah, it's that's penny stocks for you, essentially speaking. And with that being said, I'm going to go back to a previous point about cutting your losses quickly, and I'll give you a real life example because some people don't actually realize this. They just think, oh, well, I'm down 50%. But do you realize that if you're down 50% on a stock, you now need the stock to go up 100% to break even? So, an example being, if you buy a stock at £10, and now let's say the stock is down 50%, now you need the stock to go up 100%. So go up from £10, it's gone down to £5. So that's 50%. You're down 50%. But for it to get back to your entry point, the stock now needs to do 100% from current levels. So from £5, it needs to do another £5 before it gets to 10%. You know, so that's one of the reasons why I always say cut your losses quicker, because losing it is easy, getting it isn't so easy. You know, it's not often that a stock will go down 50% and then just do 100% back to the previous sort of high. So that's definitely something I would say that, you know, I mean, it's something that now that I've said it, you're like, wow, that's a really good point. But in the moment, you're not really thinking it. In that moment, I weren't really thinking it. You know, you're thinking, oh, it's only down 100%. Oh, it's only down 200%. I'll get back there. But you don't realize that if it's down 200%, that means it's got to do 400% to get back to where you was. And sometimes you just got to cut your losses, take your money, and think about the opportunity cost. You know, and that's definitely something that I wasn't thinking about at that particular stage. Now I am. And some of these losses, I ended up cutting them because I started thinking about opportunity cost. Because I was thinking, you know what, even though I'm down 40 grand, for example, and I put in 100 grand, my 60 grand, I can put it to work somewhere else. If I actually compound that amount, I'll get somewhere with that actual money, which takes me to yet another point that's probably linked back to one of my previous points. But compounding, do not underestimate the power of compounding. Again, I got too comfortable chasing the 200s, 1000%, 700s, and so on and so forth. But do you realize that if you start your trading account with, let's say, 125 grand a year, oh, sorry, 125 grand at the start of a year or at the start of any 12-month period, do you realize that if you compounded 20% by the end of that 12-month period, you'd actually have well over 1 million? You know, so you don't have to go chase 100%, 100%, because then, you know, the bigger the gain, the bigger the risk of you losing your money. Just take it easy. Chase the 20s and the 30%, the quick swings, bank those, move on, keep compounding. And I guarantee you're going to get to where you want to get to in the stock market. Thank you for watching. I hope this actually helps you guys, you know, navigate the stock market a lot better. One thing I'd say, definitely keep your ears to the news and stuff, because like I said in my previous video, the market is predictable if you know what you're looking for. But once again, thanks for watching. Make sure you like, comment, subscribe. Tell me more of what you want to see in future, and I'll try and bring that to you guys as well. But yeah, thank you.